Hi, my name is Pieris Marco, Tax and Legal Services Leader of Deloitte Cyprus, and I would like to welcome you to our new series of tax podcasts, which is brought to you as an additional feature to our tax alerts. In today's podcast, we have with us Marios Fogidis, a director in our business tax service line, who will cover the most important details of the new provisions of the ATAT, as these were recently voted into our domestic law.
Thank you, Pieris. The long-awaited bill has finally been voted into law. Together, we will now look at the most important provisions. On the 5th of April 2019, the House of Representatives voted into law the provisions of the European Council Directive for the adoption of rules against tax avoidance practices that directly affect the functioning of the internal market, known as Anti-Tax Avoidance Directive or ATAT. The directive stems from the Action Plan Against Base Erosion and Profit Shifting, known as BEPS, which is the result of the initiative of the G20 and the member countries of the Organization for Economic Cooperation and Development, OECD, to combat tax evasion through the transfer of profits to countries with preferential tax regimes. The anti-tax avoidance measures provided by the directive are the following: the interest limitation rule, general anti-abuse rule, control foreign company rule, exit taxation, and rule to tackle hybrid mismatches. These measures are included in the directive published on 12 July 2016, known as ATAT 1, while the provisions on hybrid mismatches are expanded in a second directive adopted on 29 May 2017, known as ATAT 2. Application dates. The rules that come into effect as from 1 January 2019 include the interest limitation, the general anti-abuse, and the control foreign companies rule. Exit taxation and rule to tackle hybrid mismatches come into effect as from 1 January 2020, whereas reverse hybrid rules shall apply by 1 January 2022. The provisions that apply as from 1 January 2019 are analyzed in our today's podcast. In addition, we note that related tax circulars, which will analyze in detail the practical application of the new rules, are expected to be issued by the Tax Department. Let's have a look now into the details of the three new rules. We start with the interest limitation rule. The interest limitation rule aims to discourage group of companies from providing financing facilities to companies based in high tax jurisdictions through subsidiaries based in low tax jurisdictions. The rule focuses on limiting the deduction of inflated interest arising from these practices. The interest limitation rule provides that the excess borrowing cost, which exceeds 30% of taxable income before interest tax deductions and additions, EBITDA, is not deductible for the purpose of calculating the taxable income of a company. Losses brought forward are not taken into account for the calculation of EBITDA. Exceeding borrowing cost means the amount by which the deductible borrowing costs of a taxpayer exceeds the taxable revenue from interest and other economically equivalent taxable revenues. By derogation from this rule, the exceeding borrowing cost is deducted up to the amount of 3 million euros per fiscal year per company or Cypriot group, as the case may be. Where the company is a member of a Cypriot group, the interest limitation rule is applied at the level of the Cyprus group, as this is defined in the income tax law, 75% participation group, including permanent establishments in Cyprus. Instructions concerning the allocation of the interest deductibility per company belonging to a Cypriot group are expected to be issued in a relevant tax circular of the tax department. Exclusions from the interest limitation rule. The interest limitation rule does not apply to the following: financial undertakings, standalone entities, loans used to fund long-term public infrastructure projects where the project operator, borrowing costs, assets, and income are all in the European Union. Loans which were concluded before 17 June 2016, but the exclusion shall not extend to any subsequent modification of such loans. For the purpose of this rule, financial undertakings means credit institutions, insurance companies, reinsurance undertakings, institutions for occupational retirement provisions, pension institutions, alternative investment funds, UCITS, central counterparties, central securities depositories, and securitization special purpose entities. Also, standalone entity means an entity that is not part of a consolidated group for financial accounting purposes and has an associated company or permanent establishment. Equity escape clause. Where the company is a member of a consolidated group for financial accounting purposes, it may choose for each tax year to fully deduct the amount of the exceeding borrowing cost if it is able to demonstrate that the ratio of its equity over its total assets is equal to or higher than the equivalent ratio of the group. The ratio is considered to be equal to the equivalent ratio of the group if it is equal to or at most lower by 2% of the group ratio. Carry forward of exceeding borrowing cost and unused interest capacity. The amount of exceeding borrowing cost which cannot be deducted in the year in which it was incurred can be carried forward and be deducted from the taxable income of the entity for the next 5 years. The unused interest capacity, which is the difference between 30% of EBITDA and exceeding borrowing cost, that cannot be deducted in the current tax year, can be carried forward and used for the next 5 years. It is clarified that for the calculation of the unused interest capacity, the 3 million euro threshold mentioned before is not taken into consideration. Reorganizations. In case of a reorganization, any accumulated exceeding borrowing cost and unused interest capacity will be transferred to the transferee company in accordance with the relevant provisions of the legislation regarding the reorganization of companies. We now move to our next rule, the General Anti-Abuse Rule. The General Anti-Abuse Rule, or GAR, aims to tackle abusive tax practices that have not yet been dealt with through specific provisions. The rule provides that for the purposes of calculating the corporate tax liability, an arrangement or a series of arrangements which are not genuine and have as a main purpose the obtaining a tax advantage are ignored. Non-genuine arrangements are arrangements which are not put in place for valid commercial reasons that reflect economic reality. Lastly, we would look at the Control Foreign Companies Rule. The Control Foreign Companies Rule, or CFC, has the effect of reattributing the income of a low-tax controlled foreign subsidiary to its parent and controlling company. The aim is to prevent revenue diversion to subsidiaries which are tax resident in jurisdictions with preferential tax regimes. Definition of CFC. A company or a permanent establishment, the profits of which are not subject to tax or are exempt from tax in Cyprus, is considered a CFC if the following conditions are met. A Cyprus tax resident company, by itself or together with its associate enterprises, holds a direct or indirect participation of more than 50% of the voting rights or of capital, or is entitled to receive more than 50% of the profits of that company. And B, the actual corporate tax paid on the profits of the company or permanent establishment is lower than 50% of the tax that would be paid in Cyprus. For the purposes of paragraph B, the permanent establishment of a CFC which is not subject to tax or is exempt from tax in the jurisdiction of the CFC shall not be taken into account. CFC rule. The non-distributed income of a CFC, which is derived from non-genuine arrangements that have been put in place for the purpose of obtaining a tax advantage and which are controlled by the controlling Cyprus tax resident company, is added to the taxable income of the Cyprus tax resident company. Non-distributed income is considered the accounting profit after tax which has not been distributed to the controlling Cyprus tax resident company during the tax year in which the profit is derived, as well as the next 7 months from the end of the tax period. Exemptions from CFC rule. The CFC rule is not applied where the company or the foreign permanent establishment has A. accounting profits of no more than 750,000 euro and non-trading income of no more than 75,000 euros, or B. accounting profits of no more than 10% of its operating costs for the tax period. Calculation of CFC income. The income or loss to be included in the tax base of the controlling Cyprus tax resident company shall be calculated in proportion to the company's effective participation in the CFC. The income or loss shall be limited to amounts generated through assets and risks which are linked to significant people functions carried out by the controlling company. The attribution of income shall be calculated in accordance with the arm's length principle and is limited to the amount of the non-distributed income of the CFC. The non-distributed income or loss shall be included in the tax period of the controlling Cyprus tax resident company in which the tax year of the CFC ends. Avoidance of double taxation. Where the CFC distributes profits to the controlling Cyprus tax resident company, the amounts of income previously included in the tax base of the controlling Cyprus tax resident company, in accordance with the current rule, are exempt from tax in Cyprus. Any foreign tax paid on the income of the CFC or of the permanent establishment is credited against the income tax payable in Cyprus. We are at your disposal to discuss whether and how you are affected by the above developments. Thank you very much for attending our podcast on ATAT.